On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope you're all well. That's another week behind us. Let's run through some of the market performances of last week, talk about some of the key news releases, then we'll turn our attention to what we need to keep an eye on in the week ahead. Global share markets, bit of a mixed bag. In the US, the S&P 500 slipped back a little bit last week. It was down 0.2%. It was going okay for most of the week, although it was volatile. Then on Friday, it weakened off. We had US President Donald Trump say that he was planning reciprocal tariffs on US trading partners, and that would mean the US would raise their tariff levels to match those that they're charged by others. Now, if the targeted countries chose to lower their tariffs in response to that threat, that would be a positive for global trade because it would mean you'd see overall tariffs come down, although it is difficult to predict how others would respond to that threat from the US. Some of the parts of the world we need to keep an eye on that might find themselves in the firing line include Mexico and Canada again, as well as Thailand. They're followed by the likes of Chile, Colombia, and India, and Japan also comes up as one we need to keep an eye on. Other parts of the world were a bit better. European and UK stocks continued to rise. They were up 0.7% and 0.3% respectively last week, both hitting new all-time highs along the way. European shares are up 7.6% already this year, while the UK market isn't far behind with a 6.5% gain. The local market fell 0.7% for the week, and the Aussie market across the Tasman fell 0.2% for the week. Interest rates were little changed. We saw the 10-year Treasury yield in the US finish the week down ever so slightly at just below 4.5%, while the local 5-year swap rate was barely moved. It finished the week at just below 3.7%. Some of the key releases, it was quite a big week internationally. We'll start with the US, and early last week we had the manufacturing ISM index. This is an index that gives us a bit of a feel for how the manufacturing sector in the US is tracking, and it was good news because it was stronger than expected in January. It rose from 49.2 to 50.9. 50 is where your break-even level is, so above 50 that means you're in expansion. And that was the first time we'd actually seen it above 50 in a long time. You've got to go back to October 2022. So after 26 consecutive months of contraction, this is a good sign for the US economy and the manufacturing sector. The new orders index was also well above expectations, and the employment measure in the survey was also very strong. So that was the manufacturing ISM. Then a couple of days later last week, we got the services ISM, which gives you a feel for how the services sector has been tracking. Services has been much stronger in the US than manufacturing for the last couple of years. We did see that measure soften a little bit, but it still looks pretty good. It's still above 50. That's where it's been for 7 straight months. On the inflation front, the manufacturing prices paid index rose to an 8-month high, so markets were a little bit nervous about that, but then 2 days later we saw its services counterpart drop back from where it was, so not too bad overall. We also had the jobs report in the US. This came out on Friday night, so we got the figures on Saturday morning here in New Zealand, covered the month of January. Pretty solid, 143,000 new jobs created for the month. That was a little below forecasts, which were for 175,000, and it was also down on the previous month, which came in at 307,000. However, at 143,000, that's better than 6 out of the previous 12 months, so it's not too bad. And we did see the unemployment rate unexpectedly fall. That slipped to 4.0%, which is the lowest actually since May last year. People were expecting that to remain unchanged at just above 4%. The underemployment rate, which is a broader employment measure, that was steady at 7.5%, while we did see a little bit of upward pressure on average hourly earnings. So this release pretty much firmed up expectations that the Fed will remain on hold for another meeting or two. So I think you will see another rate cut or two from the Federal Reserve this year, but we won't get that until closer to the middle of the year. I think for the next couple of meetings, they will just be on hold. So while we're talking about central banks, we did have the Bank of England last week, and as expected, the Bank of England cut its policy rate by another 0.25%. That took it from 4.75 to 4.5%, and it was the third rate cut of this cycle. The BOE policy rate reached 5.25% last year. That was a 16-year high, and now it's come down to 4.5%. Something that was really interesting about last week's decision was the fact that while 7 members voted for that 0.25% cut, 2 members wanted a bigger cut. 2 members of that voting committee, which is 9 people, wanted a 0.5% reduction, a 50 basis point reduction. So that was kind of interesting. Markets are expecting another 2, maybe 3 more cuts from the Bank of England over the course of this year. So the next move probably won't come at the next meeting, which is in March. I think we'll probably have to wait till the meeting after that, which comes in May. But the direction of travel is certainly down for interest rates in the UK. Right, here in New Zealand, good news and bad news. So we'll start with the good news. Global dairy prices keep going up. We got the results of the latest global dairy trade auction last week. Very pleasing for the agricultural sector and the economy overall, because we have got a lot of parts of the country that are very dependent on a strong dairy sector, many of those rural regions, many of those smaller regional economies. Headline prices rose 3.7%. That's the strongest gain we've seen since early November. And we saw another strong showing from whole milk powder, which gained 4.1%. So very good news for the dairy sector. Obviously, we saw prices rise overall about 19% last year. The GDT index is now up 3.7% this year. Prices at the highest level since July 2022. So the dairy sector in very good shape. We've got that higher Fonterra payout coming. $10 expected, might even be a little bit higher than that, might be $10.50, maybe even $11, who knows, but definitely very good news from what we're seeing on the global dairy front. Not so good was New Zealand unemployment, which continues to rise. The unemployment rate increased from 4.8 to 5.1% in the December quarter. That was in line with expectations, both economist expectations and Reserve Bank forecasts. It's the highest since mid-2020. Back then it got up to 5.2%, so we're just shy of that. And aside from that 3-month period, because we get the data quarterly, so apart from the September 2020 quarter, this is the highest unemployment rate we've had since 2016, and it's also above that 25-year average, which is 4.8%. So not great news. We never want to see people losing their jobs, but I guess what it does mean is that 50 basis point rate cut that people have been talking about from the Reserve Bank, that is almost a done deal. I would say it's assured that we'll see that 50 basis point rate cut. I don't think they'll do any more than that. I think 50 is enough, so I don't think you'll see a 75. That is on the 19th, I think, isn't it? So it's not this coming week, but next week, and that would take the official cash rate, the OCR, to 3.75%. Right, what's coming up? Globally, this week's economic highlights will include the latest inflation report in the US, as well as the NFIB survey in the US, that's a small business survey, and the retail sales report also in the US for the month of January. So I think the one that will get the most focus there will be the inflation report for January, the consumer price index report. That is due on Wednesday in the US, so we'll get this on Thursday, and it will be closely watched after the Federal Reserve chose to put its easing cycle on hold last month. Markets expect the headline CPI and the core CPI to have both increased by 0.3% for the month, and the headline inflation rate forecast to remain unchanged at 2.9%. So that's well down from its highs, but it's also up a little bit from where it fell to last year. And anything that sees it a little bit stronger than expected probably wouldn't be taken particularly well, because when you're at 2.9 or when you're expecting 2.9, if you do get a bit of an upside surprise, that would see it starting with a 3. And I think that might just push us into that psychological territory where we start to get a little bit nervous. While we're in the 2s, it's sort of there or thereabouts. But if we start pushing up back into the 3s, markets might not take kindly to that, especially when you've got this threat of tariff-driven inflation that is causing a bit of nervousness and unease out there. So the CPI report on Wednesday in the US will definitely be the highlight, I think. Investors will also be watching the semi-annual testimonies by Fed Chair Jerome Powell to the Senate Banking Committee. That's on Tuesday, and the House Financial Services Committee, that will be on Wednesday. So he'll get questioned by a lot of the politicians, and we'll be really interested in listening to the answers that he gives. I think tariffs will be a key topic, because we obviously saw the Fed pause, and there's good reason for that, and we're all pretty comfortable about that. But since then, there's been more news, more talk, more threats from the US policymakers about potential tariffs, and what will that mean for inflation? What will that mean for economic growth? What will it mean for trade? We're all interested in hearing what Jerome Powell and the Federal Reserve think about that. So that will be on Tuesday and Thursday. The Tuesday one probably get more attention because that's the first one, and presumably his answers won't have really changed very much between Tuesday and Thursday. Here in New Zealand, it is a little quieter week. We will have the ANZ truckometer. That's on Wednesday. We'll have the Reserve Bank survey of expectations. That's on Thursday. And then we'll have selected price indexes. That is the report we get each month from Stats NZ. This will cover January, I think. And that is a bit of a heads up, a bit of a gauge, a bit of a guide as to where inflation is going. It's sort of an early look at, I think, 40 or 45% of the inflation basket. So it gives you a bit of a steer on where the inflation rate is going. Because remember, we don't get our CPI figures, our official inflation figures. We only get them quarterly. In places like the United States, you get them every month. So this is something that Stats NZ is giving us now on a monthly basis to try and fill the gap, so we don't have to wait 3 months and only get those figures 4 times a year. It will also be a very busy week on the corporate front. The global earnings season will continue, and it's been very good so far. We've seen almost 2/3 of the market having reported, maybe about 60 odd percent, so not quite 2/3, but it's been good so far. We've seen 77% of companies exceed profit estimates, and at the moment, the annual earnings growth rate from the S&P 500 in the December quarter is sitting at 16.4%. That's way above what people were expecting. I think people were expecting 11, 12, maybe 13%. It's 16 and almost 16.5. That's very impressive. That will be the strongest since the December 2021 quarter. So for all of the nervousness out there and all the things that people are worried about, whether it's valuations or tariffs or whatever, companies are still delivering in terms of earnings, so that's pretty good. This week, another 80 odd S&P 500 companies will report, and there's plenty of big names, not just from the S&P 500, but elsewhere across the world too. We'll have McDonald's, we'll have Coca-Cola, we'll have Ecolab, Cisco, CVS Health, Nestle, Republic Services, Unilever, Zoetis, Hermes, Moderna, so lots going on. And also starting to heat up in this part of the world too. The February reporting season in New Zealand and Australia gets going this week. Actually, it's already got going, but it starts to really ramp up. So here in New Zealand, there's a couple of companies that are worth watching. Vulcan Steel got a result on Tuesday, Scalar on Thursday. Across the Tasman, it's quite busy. You've got CSL, you've got Commonwealth Bank, Computershare, South 32, Cochlear, a few big names there. Things will get even busier in New Zealand and Australia next week. That's when it really starts to heat up. But plenty to watch. More tariffs. That feels like we're going to be talking about tariffs for the next 4 years. Fed Chair Jerome Powell, that would be interesting to see what he's got to say. A US inflation reading and a bunch of corporate results, with some in this part of the world too. So thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.